In this episode, we discuss the 3 keys to being successful at infinite banking. She's Holly, and she helps people find financial freedom.
He's Nate. He makes sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered.
All right, well, this is going to be, I think, a fun episode. We're going to talk about the 3 keys to being successful at infinite banking. So if you're listening and you want to be a better infinite banker, then I'd really pay close attention. They also kind of answer the biggest questions we get a lot of the time too, or the biggest confusions, I would say. So we're going to dive into the 3 keys to being a successful infinite banker. And number 1, and this is actually straight from Nelson Nash's book, you can't be afraid to capitalize. Don't be afraid to capitalize. So what do we mean by that, Holly?
We mean that don't be afraid to put in more money or than what you're actually thinking or even saving or retiring. And what I mean by that is if you make $100,000 a year and you only want to put in a couple $1,000s a year, that's not even 10% of your income. It's about 2%. Or 1% if it's $1,000. And most people actually make the mistake of starting too low because they've gotten in their mind the idea that my retirement program, they take that money out. They never see it. And this is actually going to impact my lifestyle or my life by putting that money in. And really what they're thinking of is it's a payment instead of it's a deposit me paying myself. So I always say start with what you can afford, but also don't be afraid to push the envelope and apply for a little more and see which one actually comes out on top. I'm amazed if you find somebody who's not too ingrained in the workforce, they're often more willing to start a little bit higher in the premium than somebody that has been working for 10, 15 years. And then you see what they want to do. You don't have any cash in your program to do that because they started so low. There's no way to utilize the actual program.
And he actually says this in the book. He's like, the idea that you can pay premiums that build cash value that you can then borrow is not a new thing. People have been doing that for hundreds of years with these policies. Essentially, what he says he did was he added scale to it. He says, well, since this is the truth, since you can do this, let's see what happens if we did most of our banking from dividend-paying whole life insurance as opposed to checking accounts. I bring that up to say, like, it kind of defeats the purpose of infinite banking for it to only be a tiny little slice of your overall picture, because the whole goal is to be your own banker. And we find a lot of people are timid and afraid, but at some point, if you want to be a successful infinite banker, you have to get over the fear of putting money into policies. Because what a lot of people, our default is we like money in a checking account or a bank account. And we can't put that money into a policy because of fear typically. But if you get deep into infinite banking in any way, you'll know that fear is kind of misplaced, because the whole point of infinite banking is to be able to go in and get the money back out and use it. So a lot of the fears are typically that payment mentality, that I don't want to pay too much premium because it's money that's walking out the door. And what if I needed that money? What if it's too much? So maybe we could talk about a little bit of the flexibility there of how can people get over this fear? Because we all start there. We all enter IBC with a little bit of a fear of overextending ourselves or doing too much. But Nelson says the number 1 rule is don't be afraid to capitalize. So how can we get over the fear, and how does the system really work that allows that fear to fall by the wayside?
Well, I think that part of it is when your premium is starting, there's 2 parts of that premium, and I'm not getting too technical. I'm not going to get too technical, but one part, which is most of the policy, is the flexible part. So it can't really increase huge amounts when you start, but it can decrease. So even when you're putting that money in and you're like, I need some flexibility, there is flexibility with the policy. The reality is if you're using it as a bank, then you have to have enough money for what you spend, for what you need. So on the same hand, if you want to have more money to use or be able to use that, you have to put that money into the policy first to be able to take it out. And
I think that's a good point. I think some people see a premium as kind of taking money away, and infinite banking sees a premium as building more money. So it surprises people sometimes when I say I'm excited to pay premiums. That's kind of where you need to get to. Like, I've got a lot of premiums that are due in December every year, and that's just how the cookie crumbled. Maybe I just at the end of the year I'm like, well, I had a good year. Let's start a new policy. So I've got like 4 or 5 of my premiums come due in December. And some people are like, wow, don't you panic? Actually, no, it's like my favorite month. I'm building up all year for these premiums that are due, and I'm super excited to be able to write the checks and send them off, especially now in my IBC life. Most of those policies in December, maybe all of them actually, are 3, 4, 5 years old or older. And so I write a check for, let's say, $50,000 total for premiums this month, and I will produce cash value of over $60,000 in cash value. Is that a bad month? Do I feel like I don't want to pay premiums? What I feel is I wish that this number wasn't 50 grand. I wish it was 100,000. I'd move some money around. I'd move money from one policy to the next. I'd do something to be able to get more money into this policy if I could, because of where it's at. Some people don't make that jump though. They bring this payment mentality and then they wonder why they're not really progressing with IBC. It's not becoming a bigger deal. It's kind of like a little side thing. And if IBC is just a side thing, you won't be very good at it. You can have it be a side thing. Policy's still a policy, still probably be okay for you. Just don't pretend like you're doing IBC. Because if you're afraid of capitalizing and you're trying to keep as much money separated and you only put a little bit in and you don't really want to do very much with it, yeah, you own a whole life insurance policy as an asset that's building cash value that has a death benefit. There's some value there, but it's not IBC because there's too much money left on the side. And I'll finish with this kind of thought here. Is also one of the reasons why people don't know when or why they should ever use their policies. And I find that comes up a lot with people who have so much money that they're too timid or afraid. They have a lot of money on the outside. And so they're always wondering, like, why would I ever use my policy to fund this? I've got money sitting around doing, in a bank account. I'll just use that. And I say, well, that's the problem. The fear of capitalizing is the start of confusion and just bad IBC practice.
And Nelson even went on to say a little bit, it may sound crazy, but your premium should equal your income. And people are like, what? So if I make $100,000, then Nelson's saying your premium should be $100,000. And people don't understand that, but that's where that fear of capitalizing comes in, is they're so afraid to take that next step that they often just stay in the muddled water, and they really do a little bit on the side, but they're not really capitalizing on their income.
Yeah, exactly right. I think some people are afraid that if they come talk to me, that I'm just going to try to sucker them into buying new policies or something, as if I'm just some scumbag insurance salesman. And so they equate, I want to make sure I don't start new policies because I'm afraid that I'm just going to get sold something. Really, this stuff flies off like hotcakes if you understand what it is you're doing. I should never have to sell a policy to anybody. We should all want to continually expand the banking system. People with one policy syndrome are like, I've got the policy, I'm already doing it, I don't need to do anything else. It's really just based on that thought that once I have one policy, I'm done. And if Holly ever dares to suggest that I add more money to it to make me more money, that she's just trying to sell insurance or something like that. I don't know why people who make enough money to continually grow, they don't. And there's some fear that keeps them down. And so if people ask me, Nate, what should I be doing to be better at this? It shouldn't come as a surprise when I say, well, you should probably put more money in. That's what you can do. That's rule number one, or the key number one to being a successful IBCer is you got to get over the fear of premium. You have to come to a real understanding of what it is, that it's for your benefit to pay it, that the more premium, typically the better. There can maybe be a point where you're overextended, but there's so few people who would come to me and say, hey, Nate, I want to start a new policy, that I would then tell them, you're actually probably at your current level of premium, it's practically at your income. We're going to have to do some crazy things. I think maybe just hold tight for now. We'll see how things play out. But that conversation is very rare. Most of the time, people are kind of wondering why it's not working it perfectly for them and why they're staying in the status quo. And it's really because of this number one. This first key is that they're afraid of the premium. They're afraid of the policy. They're afraid to start new ones. They're afraid of overextending. And at some point, as Nelson Nash would talk about, you need to get over this fear if you want to be good at this. You got to see it for what it is. And Holly and I can help you. That's key number one. The second key, don't be afraid to move the money. So why do we even have to bring this up?
Because there are individuals that start the program or the policy, the infinite banking concept, and they have the system in place, but they don't ever want to borrow the money because in their mind, debt is bad. And so they won't move the money. All they do is leave that money sitting there, just like they've been taught to do with their 401k or retirement program. So this is their like rainy day fund. Yet they don't understand that it still grows, whether it's left there and they move the money and take it out. Or I actually know a client that I told him he has great policies. The money's just sitting there. He never uses it, never wants to take a loan out. And he's like, why isn't it working for me? Why don't I see that growth and the things that I should? I said, because you won't move your money, and not because there's not money in there.
Yeah, I agree. And that almost comes in on the first point, that I also feel that these fears kind of go together. When you have people who are afraid to pay premiums, they're a little worried about premiums, those also tend to be the same people who are also afraid to take loans out. And I think they go hand in hand, because it feels like a payment if all you do is put money in it and you never then take it back out and use it. You build your own payment mentality by not moving the money. And you're right. Some people are afraid of the word policy loan. They think of it as a debt. It can even stress them out that they have policy loans. And maybe we don't have enough time to go through all of these in perfect order. What I'm saying is the fears are typically misguided. The idea of a premium, the fear that it comes with, is typically based on something that's made up. The same thing goes with the fear of a policy loan. It's typically based on some pre-existing idea. And we run into this quite a bit. So I guess, what is one thing we could say to help alleviate this fear of moving the money out and taking policy loans and keeping money in motion? How could we help?
I know one thing I say to a lot of clients when they're like, but it's a loan or it's a debt, and they look at it as a liability to themselves. If you really think like a banker, Nate, and you really think like a bank does, a loan even to a bank is not a liability. It's an asset. So instead, what they have to think about is that they're creating an asset. They're creating a future to either not have the debt now, but by paying themselves back, they actually are able to get the interest that dollar earned while it's still compounding, but they're able to pay it back with future dollars that are worth less money. But if we stop the motion of money, we stop that growth. We stop the flow of it from moving. And instead, what I tell people is right now, as long as you leave that money sitting in the policy and you don't take that loan, then basically you're just sending money that you are earning to somebody else. By taking the loan, you get to bring the money back towards you and your family, and it creates growth inside it because of the compounding that's occurring. But it's really difficult.
What I like to do is actually show them how much the policy is going to grow, show them how much interest they're going to pay on this loan, to show them that it's actually an asset. Like, hey, if you make more money in interest than you pay, and most of them, when they see that, like, oh yeah, I forgot. Oh yeah. So if I have a $30,000 loan and I pay it off over 10 years and I pay $10,000 of interest, but my policy earns $20,000 of interest, that's an asset to me. Repaying a policy loan does not take money out of your pocket. It actually puts more money back in. That's why we talk about how IBC can help you turn liabilities into assets.
And the reality is, you really have to think of it like exactly like what Nate said with pockets. You have a pocket of money on your right side, and you literally borrow that money and it goes into the right side. And then you put it into your left pocket and you take the money from your left pocket and you pay your right pocket back. You literally never lose control of this money that you're borrowing out. But if you don't move the money, there is no motion from pocket to pocket. All it is deposits going in, and then you do feel like it's just a payment that you haven't been able to utilize any of your money that's just sitting somewhere that you can't.
And you feel like you have to carve money out of your budget to do it, kind of like you would like with an IRA or a 401k.
Yes.
And those worlds, you have to be conscious of how much you're putting in, because it's costly and penalizing to take the money and move it once it gets in there. And so we take that same idea. We're carving money out of our budget to put into this policy. We're begrudgingly doing it, and we live off the rest, and we never understand why we would want to move the money. And it comes from that issue.
Are you still stuck in insecurity and uncertainty? Do you want to feel like a financial genius and confident about your future? Holly and Nate have prepared something exclusively for Dollars and Nonsense listeners. It's called the Secret Banking Masterclass. You can gain free access to this course by visiting livingwealth.com/secretbanking. That's secret banking, all one word. The course will share with you how the conventional system stacks the deck against you, and exactly how to break free from their system. We believe in challenging the status quo. We believe in defying conventional wealth tools while maintaining traditional values. After all, most of those conventional tools only ever seem to make someone else on the inner circle rich. Visit livingwealth.com/secret banking. That's secret banking, all one word. Ease your worry and start your journey towards security today. Visit livingwealth.com/secret banking. Now, back to the great episode with Nate and Holly.
So point number one, or key number one, was don't be afraid to capitalize. Don't be afraid to put money in a policy. You have to see the premium in the correct light. Point number two is don't be afraid to move the money once it's there. They kind of feed off each other, those two fears that will really keep you from actually being good at IBC. And the last point number three, the third key, is that when you're doing IBC, you need to not be afraid of looking for opportunities to put your money to work outside of a policy. Key number three is look for opportunities to invest. As you build up cash values in this policy, a lot of people come to me and ask, well, Nate, I've got my car loans paid off. I've got my credit cards paid off. We've got student loans paid off. We've got some cars. We've gone on vacation. We've done a lot of things, but we still have all of this cash value. Is there anything I should be doing with this money? The only thing left to do is, well, let's start putting this money to work. Find an investment opportunity that will put the money to work and earn more money than what the policy can earn just by it sitting inside of itself. This is not a mandatory thing. You really can't be good at IBC if you can't get over the first two.
Yes.
You can't, it won't work. This third one is a little bit more optional, but it is true that we take our cues from Ray. And he is one of the best in the world at keeping his money in motion, constantly finding new ways, not only for it to grow in policies, but also for it to grow elsewhere and constantly moving money around. So that's what we've grown up in the business and seen work firsthand with somebody who's really pioneered that. So all that to say, key number three, look for opportunities to invest the money that's building up inside your policy.
One of the reasons why you want to do that is if you have the money and it's just sitting there, you do want to keep it in motion. And oftentimes we're afraid to invest that money somewhere because what if the investment goes bad or it goes south? And I think once you have the system in place and you've capitalized it and you're not afraid to move your money and take out the loans, you can actually look and see, even if the investment goes south, how long does it take me to recapture this money based on the compound interest and the growth that's occurring in that policy, or even the repayment of it right back to the policy. So the reality is, even an investment that goes bad still can allow growth to occur in your policy, but we don't see it that way. We see it as, if I invested and it goes bad, then I'm just out the money.
Yeah, before IBC came along, the only way to make back a loss of an investment that went south is to go out and earn the money by working harder, earning more money to get it back, or saving it up over time. With IBC, the policy continued to grow. So even if you borrowed $100,000 out, made an investment, it went south and you only got 20 grand of it back and the rest of it was just lost, I still wouldn't like that. But at least I know that the 100,000 that I put in, I didn't technically lose it. I collateralized it, but it's still doing things for me inside my policy. So the edge has been pushed down. It also, I think, makes people a better investor, by the way, when they do IBC, because you have this benchmark where you're earning 4 to 5% every year with no tax and no risk inside of your policy. So you're not always just trying to chase investments. You really can afford to only take the best deals. I feel like the world, since interest rates are so low on safe money, people have to just go put it all at risk.
Yes.
And that's an upsetting, nerve-wracking thing. So with IBC, we can pick and choose our investments, knowing that your money is still going to be working for you. And even if it goes south, you have this knowledge that, hey, the money is still growing for me. It's a bit of a different world. That's why you really want to try to put all the money into a policy first, then make an investment, because you always have this fail-safe of that cash value, even if we borrowed against it, is still going to continue to grow and earn. And that kind of goes back to this, don't be afraid to move the money. I'll end with this fear of the loan and repaying the loan. Some people are like, well, Nate, if I borrow the money and the investment goes south, I still have this policy loan. You're telling me that's a good thing?
It is.
Let's say we end up repaying ourselves, building back up that $80,000 loss that we had. But then the cash value over that time did not grow by 80 grand. It grew by 120 grand. Would you rather have 80 or 120? So what I'm saying is you can actually still make a profit even though the investment lost money. Or the investment could make money and you can make double money. You can make money in two places at the same time. So it is a better way to invest. To be a successful infinite banker, the third key is to take advantage of the opportunities that come your way. Don't be afraid to look for things that you might be interested in that can help you grow the wealth even faster.
And I'm going to say you don't have to take the investment if you don't want to, because you have that freedom or peace of mind. You're not trying to earn extra money to have to replenish it again.
Absolutely. Well, I think it's been a great episode. 3 keys. 1, don't be afraid to capitalize the policy. You can't let fear of premium ruin it for you. Number 2, don't be afraid to move the money. And number 3, look for opportunities to invest. This has been Dollars and Nonsense. If you follow the herd, you will get slaughtered.
For free transcripts and resources, please visit livingwealth.com/E107.
Dollars and Nonsense podcast listeners, one more thing before you go. Ease your worry and start your journey towards security today. Visit livingwealth.com/secretbanking. You'll gain instant free access to the special 1-hour course Holly and Nate made for you. Again, that's livingwealth.com/secretbanking.